Okay. All right.
So now we're on live stream, right?
Yep. Go ahead.
All right. Then I have the pleasure to say good morning, good afternoon, and good evening. Really, regardless where you are, so welcome all to Pern Salon. My name is Lotta Björklund Larsen. I'm speaking to you from Stockholm. I'm a research fellow at University of Exeter in the UK. And especially, well, I would say good afternoon and welcome to our special guest, Christian Borch and Kristian Bondo, who's speaking from Denmark. And I have, as I said, I have the pleasure of moderating this. I think everybody, if there are any first-time attendants, so this is the Platform Economies Research Network, which is a learning collaboration that focuses on the socio-technical basis of platform economics. So we do various research on digital platforms and processes that gain insight into how data becomes value. So it's really a socio-technical approach to understanding what is going on here. These platforms could include information infrastructures, computational technologies, new finance technologies that we will hear more about today, for example, and emerging practices for automated pricing or taxation and risk assessment. Our collaboration is based on the conviction that also social scientists must learn about the architectures and operations of the digital technologies as a fundamental aspect of our research. So therefore, we combine the technical and the social that is often otherwise separated. Pern is international and interdisciplinary, and members reside in the United States, Canada, Europe, Australia, and East Asia. And I think we are present from all these different corners of the world here today. And include also scholars from anthropology, economic sociology, history, information science, political science, and media studies. And please add if I've forgotten someone here. We also are very keen on providing mutual support to members and collaborators. And so we run regular online meetings where there are open-ended discussion of work in progress. That could be anything from fieldwork materials or research to more analysis or finalized papers. And we also run this regular live stream saloon series that we today are doing that brings our conversations to a broader audience. So we welcome saloon presentations in all forms of media as a way to foster the exchange between academia and industry. So again, welcome to today's saloon. But before continuing with this really exciting paper and with our two Danish guests, Janet Voigtman, the initiator of Pern, has some exciting news to share. So I leave it to you, Janet.
Yes, thanks so much, Lotta. Just very briefly, I'm a professor at the New School in New York City. I'm also an honorary professor at RMIT University in Melbourne, where I'm sitting right now. But I would just like to take the opportunity very briefly to announce Pern's collaboration with the Center for Excellence in Automated Decision-Making in Society. We're thrilled about this new collaboration, which has been announced. Maybe you've seen it, maybe not, but I wanted to make sure that that was stated publicly. I really want to thank ADM+S for their interest in our work. And I would especially like to really welcome any ADM+S members who are online with us and invite everyone sort of to keep an eye out for our future events, both online and in person. So I will stop there, and I'm really looking forward to the discussion about this paper. So thanks.
Thank you, Janet. It's really exciting, this new collaboration here. So anyway, in today's saloon, we have Christian Borch from University of Copenhagen and Kristian Bondo Hansen from Copenhagen Business School, who will present the recently published article, Alternative Data, Sentiment Analysis in Machine Learning Finance, that has recently been published in Big Data and Society. And Christian Borch, Christian number one, if I may, is a professor of sociology at the University of Copenhagen. And his research lies at the intersection of the sociology of financial markets and the sociology of technology. And in his recent work, he examines the role of and risks posed by machine learning systems in financial markets, using these markets as a laboratory for understanding the sociological impact on machine learning systems more broadly. Kristian Bondo Hansen is a postdoctoral fellow in the Department of Management, Society and Communication at Copenhagen Business School. And his research examines the use of big data and machine learning techniques in various industries and organizational settings, and the socio-economic and ethical implications of this quantification and datafication of society. And I also learned that he is a member of the AI Reuse Research Project. That was really exciting, I thought, to read your article, and we really anticipate a good discussion. So before I leave the word to you for saying a few words about your article, so maybe we can listen a little bit to how you arrived at your research, the key themes and the particular issues that you would like us to discuss further with you, even if this is a published paper, and also perhaps excitingly, what's next? We can't wait. So 10-15 minutes, and then we let everybody else in. And, you know, as usual, if you have any questions, please raise your hand or put questions into the chat to remind me so I don't overlook anyone. So Kristian and Kristian, please.
Thank you so much. Sorry, maybe Kristian, you should start out, because this research really, or this paper really grew out of a research project that Kristian led previously at Copenhagen Business School. So maybe Kristian should start by saying something about that. Sorry for interrupting you.
It's perfect. I go first. That's fine. So thanks a lot once again for the invitation. We are really pleased to be part of this saloon today, and it's such a great company that we're in. So we've really been looking forward to that. Before saying a bit about the background of the paper, perhaps I should emphasize that, contrary to what you might think right now, not everyone in Denmark is named Christian. So you shouldn't infer too much on the basis of 2 data points, as you probably know. So this is a mere coincidence, of course. Anyway, in terms of the background for this paper, it grows out of actually a number of research projects, and the biggest one of those was one that was funded by the European Research Council some years back. It was a 4-year project concerning algorithmic trading, basically the ways in which the use of algorithms within financial markets used for trading purposes, the ways in which these algorithms are transforming, reshaping financial markets. And that project included a handful of researchers. There was a physicist, an anthropologist on board, and then a couple of sociologists or social scientists working on the financial markets. And I don't want to say too much about the project, but one of the basic things that we did was that in the social science part, at least, we did a number of interviews with market participants who are specializing in automated trading in one way or the other. So we did a lot of interviews with traders, software developers, regulators, exchange staff, etc., etc. And the firms in which we did interviews were primarily located in London, Chicago, and New York, but also in a couple of other places. And so in the course of this work, we came to realize that an increasing number of firms were specializing in various types of machine learning techniques. So that was actually kind of unexpected, at least compared to the original grant proposal. But we could see that a number of firms were really taking an interest in deploying various types of machine learning techniques for the purpose of automated trading. And as you know, the flip side to machine learning would be data. So as part of this interest in machine learning, we also developed an interest in data, the kinds of data that firms would then be focusing on. And most of the firms that where we did interviews would focus on traditional price data, so-called order book data that you would usually find at a stock exchange, for instance. But we could also see that some firms would be specializing in alternative forms of data, so data that are not really traditionally used within the financial markets for trading purposes, at least. And this is then really where this paper takes its interest in firms that are specializing in these types of so-called alternative data. And this fitted in nicely also with what Lotte just said about Christian's work. So Kristian became affiliated with another research project on the data reuse, and that ties in nicely with this interest in alternative data, because that's really about repurposing non-conventional data or finance data for data purposes. So that's sort of the background to the paper. I don't know if you want to take over.
Yeah, I can do that. So, like as Kristian pointed out, we did a large number of interviews with different types of financial actors, and then eventually, when we realized that machine learning was not just merely a fad in the investment management space and algorithmic trading space, we also realized that there was a budding industry of data providers that cater to hedge funds, algorithmic trading firms, etc., to basically push different types of forms of data that were also like non-standard data. So one of the ways that alternative data is organized or is defined is as being non-standard data. So the standard data would be the market data that Kristian talked about. So we realized that there was a whole industry basically providing data, and in many ways it's not like super surprising, but being very much focused on especially high frequency trading that is very much solely about order book data. We rather quickly realized during the course of our field work and interview work that there was this deep interest in the field or among practitioners in alternative data sources, and we began to think about ways to analyze that. And as Kristian said, I have been affiliated and still affiliated with a project called AI Reuse, where we look into the repurposing of different data forms in machine learning context, and therefore I also found it relevant to discuss the alternative data space in finance, because it is, exactly as Kristian pointed out, is a field that is characterized by repurposing different types of data that comes from different fields and being brought into finance, and figuring out ways to utilize those types of data for ulterior purposes and money making, basically. So, yeah, maybe Kristian, would you say something about the theoretical framing of the paper, or should I go ahead and do that? The assetization and prospecting part.
If you go on a bit, then I can jump in later.
So, like a central part of and I should obviously keep this short. A central part of the theoretical framing of the paper was to look at how these different actors in the alternative data space, they provide data, and from the data brokers provider side, and on the investment managers side, or the investors and traders side, they have some techniques, some models that use specific forms of data. So what we were interested in was the sort of bridging this gap between data providers and users of data. And we tried to describe that in the paper as a standardization of non-standard data. And we do that through two theoretical lenses, if you will. So one is the concept of prospecting, which is basically a term that covers the idea of organizing the unorganized and finding out ways in which data can be structured in a way that it is rendered amenable to analysis with certain data science tools. And another part of this standardization process is is basically the way in which the data becomes valuable to the ones providing the data. So that will be the assetization part, which is obviously something that you have, the Perns Salon and network is really interested in, and Keen and others have worked on a lot. So we found it interesting that there is this constant process of trying to figure out how to order data on the data broker side, and also on the data broker side, finding out ways in which this data can become valuable, and become valuable in a way that it is a constant generator of revenue. So it becomes valuable insofar as it can be repurposed and packaged in a way that it can become useful for investment managers and asset managers and trading companies.
Yeah, and perhaps I can add to this. I'm sure many of you are familiar with the work by Donald McKinsey on really high-speed forms of trading. And what we're describing here is really niche vis-a-vis or compared to what McKinsey is describing. So he's describing these super fast automated systems that are really exploiting micro, even nanosecond kinds of price differences in the markets. And given that these are so super fast algorithms, they also depend on very expensive data transmission infrastructures, and not all firms really have access to that kind of infrastructure. It is really super expensive. Also, the data are really expensive to get. Order book data can be really expensive if you're doing high frequency trading. And exchanges today are earning an increasing share of their revenues actually from selling data. So this is becoming really important also to stock exchanges today. So we have also a huge group of firms that are trading differently than high-speed trading firms, that are utilizing a different kind of time perspective, looking much further into the future than would high-frequency trading firms do. They really only focus on, say, a couple of seconds or these kinds of time horizons. So much of the alternative data that we are looking at would be utilized by firms who take a much longer time horizon. That could be 3 months into the future, 6 months into the future, even longer. And they're interested. So some of the stuff that we discussed, or some of the examples that we discussed in the paper, concern ways in which firms are trying to use Twitter data for stock market price prediction, for instance. So there are firms that are basically scraping Twitter, trying to get some sentiment data out of Twitter, and they're then selling these data to investment firms in a kind of digested manner. And then the trading firms could make the decisions on the basis of the data that they bought. But this is really, you know, a completely different ball game than the high frequency trading stuff that McKinsey is describing. So we also interviewed automated trading firms that are doing the kind of high frequency trading, and they would say often that, well, we do some of the firms would look into also alternative data, Twitter, but it would constitute only a fraction of the kind of signals that they would consider relevant for their trading operations.
Yeah, so in the paper, we are really preoccupied with the social media data, but as Kristian said, that is just one out of a number of different types of data that constitutes or are brought into under the umbrella of the alternative data moniker. In addition to social media data, there are all sorts of textual data. There are satellite imagery. There are all things related to Internet of Things, sensor data, crop moisture data to assess the growth of crops in different environments to determine the price of commodities in the future, or try to predict the harvest. So there are all sorts of different types of data, sources of data that are categorized as alternative data, and what they have in common is that they are often unstructured. They are hard to sort of comprehend analytically. So one of our informants says that it's everything that is not neatly that cannot neatly be pushed into an Excel sheet. So there is a work to be done before this type of data becomes usable for an investment management firms. Therefore, there is this prospecting and process of like connecting or ordering the data in a way that it becomes analyzable, and therefore there is an interesting process going on between like the interest, having an interest in utilizing these types of data and actually be able to doing so, and it is said in a very bombastic way, but we have this quote from a quant working in one of the biggest US hedge funds, a New York-based US hedge fund, who says that their ambition is to build a technological infrastructure capable of harnessing all the world's data and to be able to infer useful information from it. So that is like, it's very much a sales pitch in many ways. And one could say like the ambition to harness all the world's data, that is a bit bold and ambitious, but it says something about this, the attitude of the types of hedge funds and firms who try to utilize these different types of data sources. They consider all types of data potentially finance relevant, because there could be some edge to be discovered in all types of data if you have enough of it and you're able to process it. But it also requires an infrastructure. And what is said in this quote is that it's a technological infrastructure. What we also realized when we did the work was that it is a very much a socio-technical infrastructure. So it very much also matters who has the who are the intermediaries between the ones who possess the data and the ones in need of the data. How is it marketed? So how is it delivered? So these data providers, they categorize the different types of alternative data in categories. It could be satellite imagery, and then you can determine at what rate you want the data, how much of the data you want, how you want the data. So it all plays into how you're able to digest the data on the opposite side, on the investment management side. So like, and so that was just to say that there are more to it than just social media data and Twitter scraping, etc. But that is what we've been focusing on mostly in the paper, and is actually, or we find it quite interesting. But maybe to end our little presentation also with some of the things that we might want to look into going forward, and some perspectives from the paper. So Kristian will say a little bit more about this, but I've also taken an interest in the rise of online retail investing. So the whole GameStop thing, the Wall Street bets, mobilization of so-called dumb money on the web, and pouring them into specific stocks, that has generated a lot of controversy, obviously, in the media, but also a lot of potential for doing sentiment analysis on like the discussions, the conversations going on online. And the SEC's chairman, Gary Gensler, he has said relatively recently that is something that the SEC, the regulator, the US regulator of the Securities Exchange Commission, they'll be looking into, because they have a concern about whether or not it will be possible to manipulate markets by inferring signals into these online communities and then make them jump on specific stocks, and thereby using your analytical prowess to basically manipulate other people to do something, and then trade on it before they're able to do so, or trade in the opposite direction. So that is a regulatory concern. Then I also have an interest in the historical antecedents, if you will, of this development, because there is a lot of reminiscences of old ideas about the stupid crowd and the stupid public in these discussions, but that's another story. But maybe Kristian wants to talk a bit about that because he's actually doing a project on it.
Perhaps we should just open the floor. Isn't that better? I mean, I guess we have been speaking for too long already, Kristian. I don't know. Yeah.
I'm sorry.
This is all very fascinating. I then take the cue. So, I mean, loads of questions I have. Because I was actually part of when the digitalization of market started, and I came to think of also Kaikin Saloom's book about how it went from working class guys who was on the floor to actually when they started to digitalize it and use also economic models more. And I think to your paper in some way, you speak to that a bit of using the economic models, the traditional data versus the more alternative data. And I just wondered, this is perhaps an empirical question, but has there been any comparison between trading just on sentiment data versus trading on just traditional economic data? You mentioned it a little bit in the paper, but there is more like we cannot go all the way towards the sentiment data, trading on that. But
I'm not sure. I personally did a systematic study of that on these potential benefits of focusing solely, say, on social media data. There's a couple of papers, or actually a bunch of papers published on this, but I think the results vary a bit, and I'm not sure how much credibility they have in the actual investment world, to be honest. So it is possible that you can demonstrate that you are in an academic paper that your model can predict stock prices, but whether that actually works in practice is, I guess, a slightly different affair. I mean, it's hugely complicated to make money in markets, and many of the firms that we interview, they struggle. But concerning the first part of your common question concerning Saloom's book and the transition that she describes so nicely from pit trading to electronic trading. I think one of the interesting facets, if we're taking up that clue, is how contemporary the contemporary investment space is also seeing a reformatting of expertise, very much very similar to what Saloom describes, right? So my sense is actually that it's not so much about economic models. So many of the persons we interview, so these automated trading firms at least, they would be highly critical or skeptical about recruiting economists. Some would say they would never hire an economist. And the problem is that, according to these informants at least, that economists are coming with all sorts of preconceptions about how a market is supposed to work, but actual markets may look rather different. So this is precisely why they're interested in computer scientists and physicists who have no sense of what the market should look like. They just have data, right? So they are looking into data and seeing how data or the kinds of markets that are emerging from data. So expertise, the kinds of expertise that are important here are certainly rather different now than at least compared to the pits, obviously, but also the early forms of electronic trading.
Thank you.
Kristian, if I may jump just in here, I thought it was interesting because I've been collaborating with some folks at UniMelb who are doing sentiment analysis in sort of the defense space, if you want, because lots of defense industry is looking at now at Twitter and similar things to try to understand things like how the misinformation or disinformation spread. And one of the things that you realize as soon as you start getting aggregates of data coming from Twitter is that it's actually not just super messy, but what actually sentiment means is very complicated in a quantitative sense, right? So you can have a bunch of hundreds of tweets from bots that all try to create a sentiment, and then you might have one that goes viral for something completely different. And it's very hard when you try to have a model that predicts through quantitative elements, especially to then sort of structure it. And so I guess my question is, if you have computer scientists and or physicists trying to understand sentiment in that sense, I mean, how sort of, how does it work? Is it at all relevant, or then it becomes sort of like, well, I've got all this Twitter data, I think that means that, and so I'm just gonna go with actually my own model of what I think the data is, rather than the computer scientist or brokers model of all of that.
Yeah, the difficult thing about this is that we both our names are Christian, so when you address Christian, yeah, I'll give it a go if it's okay with the other Christian. I hope so. But I think that is exactly also why our informant, as Christian said, are very reluctant to rely solely on sentiment analysis based on social media, and we have this example in the paper we interviewed a guy from a rather big European hedge fund, and he used it did sentiment analysis on not on Twitter data but on like some of these sites specifically dedicated to finance. So there are Twitter versions of financial chatter and Google Finance, Yahoo Finance, etc. But the point being that he did it in a very simple and pragmatic manner. So he said that I just collect all the data that I have from these sites and buy it, and then I see if people are talking about a certain firm, then I'll just go ahead and short it, because I think my gut instinct is that the public by default is not as clever as when it comes to buying stocks. So that is a very simple contrarian speculation that he made, but he justified it by saying, obviously, I only do this because it seems to be working, and as soon as the signal, as he would call it, is not strong, then like I wouldn't go that way. So that is a simple way of doing a kind of sentiment analysis, but basically also just a text analysis that are inferring that people have certain sentiments or being carried away when they're talking about something in a great number of times in a large group of people. So I think that's part of it. And another thing is that like that is a way of inferring bias, or having an opinion in another way about trading. So as Christian said, that there is this you want to get away from the biases of economists about how markets work. So now we even see like a development where you and Christian has done work on that, where you even automate the strategy making. So like you don't even have an opinion about whether things should go east or up or down in the market. You let the neural networks or whatever you have working for you develop the strategies themselves, so that you only feed it with data, and then the strategies emerge iteratively from that. So there is this fetishizing of being unbiased for sure, but I think you're right in saying that the sentiment analysis part can be very tricky, and we also have this example with a fake account saying that Obama was injured in a bomb attack on the White House, and obviously that caused some big like fluctuations in the market, and that was just a scam or hacked Twitter account. So there are all sorts of issues associated with relying too heavily on these kinds of things.
Did anyone want to pick up on that, or should I go?
Please, Andrew.
Yeah. So yeah, thanks so much for joining us and for your paper. It was terrific. But I want to pick up on something you said just a moment ago about the shifting of expertise from economists to computer scientists. So it's about the two organizing concepts in your work, prospecting and assetization. And I thought it was, smart and really informative to think about prospecting and assetization as a means of standardization. But I guess in that sense, and picking up on what you just said also, I think I wanted to know more about, for example, work from information science on standards, classifications, or database design. I was thinking, and I'm not an expert, maybe Linda can jump in, but the role of non-relational databases, where relational databases were too hierarchical, restrictive for unstructured data, but your refs were more economic sociology. So I guess I was just curious, what if we read your narrative about prospecting and assetization, not as updating, say, financialization and capitalism, but as centering or updating information science and computing. So yeah, I mean, beyond the thought experiment, if you said this, this is information science in practice, you'd probably go to different conferences, you'd publish in different venues, your interlocutors would also shift. You'd still be here with us though, because we're interested in information science. But also I think this story on assets and assetization, which is very efficient and fluent at the moment, wouldn't be may not be so familiar, right? It might be less transactional and modular, which might have its pros and cons. So yeah, I was just curious, I guess it's more of a comment question about your choice of secondary sources and so forth, and whether you see that as an angle that you might amplify and expand upon. Thanks.
Yeah, thanks a lot. I must confess that I'm really not an expert on information science, so I have some difficulties responding because I don't know, Christian, do you have
no, I think what we can say, thank you very much for the comment. I think we basically jumped on this concept of prospecting because we read the paper by Hoffman and Bauker and Rebus, and we found it to be a very good theoretical lens to frame the paper with. So I'm sure that if you move into informational science, there will be a whole lot of different types of questions that should be raised also with regard to how we organize this like the data, and we analyze the data from our interviews. And what we can say is that I think we might have done the same thing that people in finance do, that they work quite pragmatically with these things. So like we used it because we thought it worked. So maybe like we perhaps both too much of a pair of novices when it comes to information science to be really eloquent about saying much in response to that. Yeah.
All right, thank you. Now I have a number of hands raised. Very good. I start with Francisca, please. We cannot hear you, Francisca.
Sorry. I kind of wanted to open a new topic, so if anybody else wanted to comment directly on that, I would be fine to let them go first. No?
Please.
Okay. So I wondered, you said it was a kind of a niche, comparatively a niche phenomenon. I wondered still if you have a kind of an indication of the scale of the phenomenons. As I'm not an expert on alternative data, but still my understanding was that also firms like basically all large firms kind of say that they use it, like JP Morgan, Goldman Sachs, and so on. So maybe it's difficult to know to what extent they really use it, but I would be interested, like how how big is the phenomenon? And also related to that, who are the players here? Is it just like data providers that are always separate from the large established finance and tech firms? Or because I would kind of think that there might be an incentive to do it themselves, so that they would have an advantage over others and have more control over the quality of the data and so on. And related to that, I wonder, like, where do you see this going? Is it something that will lead to a contestation of existing kind of power dynamics in finance, or maybe rather a solidification of those firms that have a lot of resources to get this data? And related to that, you work with the concept of financialization, and I wondered, like, is this really ultimately financialization then that we are observing here, or what is it? Yeah.
Thank you.
Thanks a lot. So I can go first here in terms of also the niche stuff, because I think I was the one making that phrase. So it's niche, I think, in terms of I mean, if you look at automated trading on a more general level, I think according to some estimates, some of you are sitting in Australia. I think the Australian markets, in the Australian markets, more than 99.6% of all orders, all messages that are sent to markets are sent by fully automated algorithms. So markets are practically fully automated in many parts of the global north, at least. Now, within that kind of ecology, my clear sense is that alternative data is still just a fraction, because much of the activity that is taking place would focus on order book data. But of course, it's probably a growing field. That's also what we can sense. A growing number of firms that are providing these kinds of data, a growing number of firms that are also trying to deploy them. You mentioned JP Morgan, etc. But one of the difficulties of doing this kind of research is that, and that applies both to this specific topic of alternative data, but also more broadly to the application of machine learning models, is that a lot of firms would claim that they're doing machine learning, for instance, or that they are utilizing alternative data. But the extent to which they're actually doing it in practice is very difficult to really grasp, also through interviews. So there's a lot of window dressing also in this, in terms of being up to speed with all sorts of developments. So the exact scale is really difficult to really pinpoint, I guess. Then in terms of who are the players, I think there's certainly a lot of firms, also some of the ones that we mentioned here, that are really trying to harvest these data up and resell the data. And as we mentioned earlier, stock exchanges are getting an increasing share of their revenues also via data. They're selling data to clients, and they are buying also alternative data providers as part of their sort of data provision repertoire. So data providers are external, but there are certainly also firms that are trying to in-house this kind of stuff, definitely. Where's this going? Is this leading to a consolidation or what? Yeah, I don't know if you have a view on this, Christian. I guess what is really driving this is, as Christian also mentioned earlier, that's the constant search for profit, or the constant search for an edge in the market, right? And firms would do everything basically to get new types of profits. Doing classical automated trading is becoming more and more difficult because the competition is really hard, and you need, as I mentioned earlier, you need to pay massively to get access to the high-speed data infrastructures. So that naturally forces some firms into alternative venues, and also of looking into whether alternative data might be a different way of trading in the markets or investing in the markets. And then regarding financialization, yeah, I mean, we're using it as a kind of, you know, it's more or less like we use assetization in the market. I get your point about this being a different kind of application of the term than you would find in the normal financialization literature. So in that sense, it's a kind of pragmatic use, like Kristian said earlier. But it's again, just to pinpoint this fact that data here are also becoming very core to the financial markets, and data, once again, that were not really part of the conventional repertoire of you know, finance data in the past. But I don't know if you have anything to add on any of these dimensions, Kristian.
No, maybe just a few short comments, and thank you, Franziska, for some very good and hard questions. I would say one thing is that, as Kristian also alluded to, that it's very difficult to determine how much it is being used, and that is also the issues related to access. So you say that it would be obvious for players like JP Morgan to use it, and they would claim that they use it, and they would probably also just buy the data and without a lot of intermediaries like taking a cut along the way. So there is a bit of an issue related to the methods, if you will. So one would have to do a much more in-depth analysis of the data brokerage ecology to say who are the big players and how do they act, how is the assetization of data happening, if you want to call it that, in these different types of intermediaries and from data providers to data users. But so, like, one of the things, and that is anecdotal evidence, but many of our informants say that, like, we cannot afford not to experiment with alternative data analytics. So maybe it's not our primary source of revenue, but we cannot afford not to try it. So I think that there is a lot of experimentation in the field with especially things like social media data, but there are also much more conventional ways of utilizing alternative data. So scrolling through a lot of text data is important parts of compliance. And we also mentioned credit scoring and fraud detection as areas in which alternative data is very massively used, and obviously where machine learning has been used for a couple of decades. So there are areas where it's more like pedestrian, if you will, or mundane ways of using alternative data that are very common, that are basically cost-cutting exercises, and not like the more profit-seeking, or that is profit-seeking, but not seeking edges in the market by figuring out exactly where the price of XYZ is heading in the future. So I'll not touch on the financialization part, but I think too much. But I would say that the way we try to frame it is that to say that financialization in this context is the mere fact that a lot of different data that is that doesn't seem to be finance related whatsoever is potentially finance related and potentially worthwhile assetizing, and that is sort of what we call a financialization on the data level.
Next, I think Keane, please.
Thanks a lot. Yeah, really enjoyable paper and really insightful points in it. I had a question that comes from a place of my own ignorance, and that's to do with, I guess, legal fiduciary responsibilities here. Are there fiduciary responsibilities as a, if you're trading, to draw on particular kinds of proper market data, right? So that you have to, so that, if you don't draw on the proper market data, you could be sued later by your investors because you've made a series of decisions that could literally be, does my cat walk left or right, and I'm going to make an investment decision on the basis of that. Now, even if you tell the investors that's how I'm making my decision, my cat's walked left today, therefore I'm investing in X, and my cat's walked right, and therefore I'm going to invest in Y. Is there some sort of legal comeback that investors could make if you are using certain kinds of data, alternative data, especially, your comments about, that kind of the idea that there's dumb money, stupid crowds, and things like that, where if your policy of investing is to follow the crowd and everyone knows that the crowd is dumb, then, is there a legal recourse to sue because of bad decisions, lost investments, all that sort of thing? It seems like a really interesting, legal conundrum there, around information, market information, and how market information is understood and deployed in making decisions. Yeah, just fascinating. And as I say, that comes from a kind of position of ignorance. I just don't know. So I was wondering if, yeah.
Thanks a lot. I must confess, I'm not entirely sure either whether there's a kind of legal boundary to what you can do in terms of the data that you deploy. I mean, I know that, for instance, BlackRock, they do deploy also alternative data. They do experiment with alternative data, and I'm not aware of any news or stories about them, discarding any such models. I'm aware that years back they had to discard a model that they couldn't explain, some kind of neural net based thing where they couldn't explain the inner workings of it, and they were fearful about any kinds of responsibilities that might grow out of that in terms of what you just described. But that was not, as far as I'm aware, based on alternative data. I think that was more conventional stuff. Are you aware of any legal dimensions here, Christian?
No, but what one obviously can say is that fiduciary responsibility only applies to people who are like asset managers who manages the money of other people. So proprietary trading firms are able to do more or less whatever they like for their own money. That's not true, because they're also obviously regulated, but there is this distinction. I haven't heard about it being a problem to use certain types of data, but there certainly are regulators that are concerned with the many different new types of data being used. So that's maybe another way to put it, that there are regulatory concerns about the many types of alternative data being utilized and how they're being utilized, but I haven't heard about it being going against the grain of the fiduciary responsibility of investors. They are concerned, some of them, with whether the information or the data that they use is public or private information, because if it's private information, they're doing insider trading. So that's another more direct regulatory or legal issue, and that is a concern that some of our informants have had with using social media data. How they've been concerned whether that would be characterized as public or private data. And then, of course, there is the whole with the data protection laws in the US and the GDPR in the EU. There are lots of issues around compliance when it comes to applying these different types of data that are not strictly anonymized as traditional market data is, and therefore there are some other legal quarrels that firms need to consider when using these types of data, especially social media data.
All right, thank you. This is all so interesting. Ying, please, next.
Hi. Can everyone hear me well? Yeah. Excuse me, I need to update my software for the camera, so I may look veiled and oriental. Yeah, so first of all, I would like to take this opportunity to thanks to Perm for organizing everything and including me for such an interesting discussion. And also it's quite a bonus for me that I finally see Dr. Borch. We were on emails for his edited volume, the Routledge Handbook for Critical Finance Studies, and I really enjoyed the collaboration. Now I finally see you, although it's still on screen. And also great to see you and your colleague, Dr. Hansen, and really enjoy learning from your research on this cutting edge topic. So my most immediate comment, so I'm kind of embedding my questions in my comments. So my most immediate comment is that how did you organize such a big scale qualitative research, including managing interviewers, recruiting interviewees, etc. Although there's only one paper in front of us, but I think the research that you have done has created such a valuable repertoire that provides data, case studies, and even teaching materials for understanding the role of alternative data in finance. So I guess I'm curious whether you have further plans for this collection of interviews and the field work, but it seems such a rich source to elevate topic of alternative data. So my question is more about methods and also your future research plan based on this collection of field work. Then what struck me the most is the idea of when the alternative becomes the placeholder. So it is not only the growing financial capital in its traditional forms that lead to the deepened financialization. It is also the digitalization and the assetization of non-traditional market information that expands the territory of finance. So in this sense, alternative data as a rising topic in critical big data research really points out a new dimension for the social studies of finance. Yeah, so this is the thing that struck me most for reading your paper. In the meantime, I want to bring up this who question, which I think is also pertinent in understanding the value of alternative data. So this research emphasized that alternative data has become an open-ended and dynamic placeholder. So to me, the who question is even more intriguing. The article maps out that the central actors, quote, the central actors are a diverse array of investment management firms, proprietary trading firms, and data analytics firms, as well as security exchanges, unquote. So this finding answers the question of who entitles value to alternative data and who validates them, right? But I'm also thinking that there must be an ecosystem, or in Christian's words, the ecology, right? There must be an ecosystem existing in the context of traditional finance, which is being transformed by the applications of alternative data and then still function in the finance context. So it will be interesting to look into how the various actors actually reach an agreement upon the value of alternative data and how they collaborate with each other in the value-making processes. So I think these questions provide us with opportunities to enrich critical studies of finance. Then what's at stake is not only about critical data studies, it is also about the political economy of finance, right? The collaborations of these various actors. In addition to understanding the ecosystems of alternative data, what is a larger socio-economic background that shapes this new partnerships. I mean, financial capitalism needs new oil to fuel its engine, right? So I think this is crucial to understanding the new forms and the consequences of financialization in the big data era. Yeah, so this is my comments together with a sort of maybe larger question that helped me bring up some further discussion. Last but not least, since a Chinese scholar jumped into this discussion, so perhaps she should slightly mention what's going on in China. So what's interesting here is, to me, it's really the shifting institutional dynamics. As alternative data used to be very accessible between 2012 and 2018, before the data security law was launched. So it's very accessible price-wise and channel-wise, very accessible. Then a data market, alternative data market is formed because of the financial firms' increasing interest in non-traditional data, or what they call external data, in contrast to the internal data that the firm's own platforms could generate. But recently, the firms started to doubt the usefulness of such data. One reason is because this kind of data, they feel like the lack of models to verify the usefulness of external data. And the other reason is they feel it's very hard to get those alternative data integrated into their existing models, which is more trustworthy, persuasive to their customers or institutional investors. So my reaction to this phenomenon is that, of course, this needs needs further investigation. But my intuitive response to this phenomenon is that if we have this simplified divide between the institutional versus the utilitarian, so the philosophy of standardization, modularization, and assetization are institutional for sure. Whereas alternative data and maybe data of other kinds, emerging data of other kinds, they are being utilized. So it will be interesting to look at the shifting lines between the institutional versus the utilitarian. Yeah, yeah, these are some of my thoughts. Back to you.
Thank you.
Thank you so much for this, and great to meet you also finally. So let me just say a few things about this. First of all, fascinating stuff on the Chinese context. That's really valuable for us as well. In terms of how we kind of structured the qualitative work and access issues, etc. So we were basically 4 researchers doing these interviews, working from a common or a joint interview guide. It would be semi-structured interviews. It was kind of iterative process. We tried out the interview guide, and then we made certain advances, and then we had to go back and change a couple of things in the interview guide. And we also wanted to shift the focus occasionally, and that also required certain updates. I think the most critical part of it was really access. It's a field where people, I mean, it's fairly difficult to get access to many of these types of firms. So I don't know how many LinkedIn invitations we have sent out and never got any responses back on. It's, you know, the numbers are really high. I think at some point I had calculated our success rate to something like 10%, and so a lot of requests, very few responses back. But once we sort of got into the field, then we could snowball a bit, and that made things a bit easier. And also a lot of the people in the field would have PhD degrees, research backgrounds, and they would have a kind of a semi-natural interest in talking to other researchers and telling just a bit about their work. And so in terms of future plans about the work that we have been doing on, or the interviews that we've been doing, so we have a number of papers out on this, and I think Christian is working on a book also, and I'm also working on a new book based on some of these data. So I guess we'll be working on this material for a couple of years more at least. Just one final comment, perhaps. You touched upon the who question and who's ascribing value to these kinds of data, and whether they are reaching a kind of agreement on the value of these data. I'm not sure they would reach any agreement on the value of these data, but that's probably also what ensures the dynamic of this. So firms are constantly pushing in new directions in terms of exploring new opportunities. One place where there is some sort of consolidation is the one I've mentioned previously in terms of stock exchanges selling a lot of data. So they're really trying to consolidate in terms of merging or buying data providers in order to be able to really profit from these kinds of sources.
Janet, please.
Yes, thank you so much. I was just waiting to give the Christian too an opportunity to respond as well. So I have tons of things to say. So I'm sorry if I go on. I try not to go on too long. Thank you so much for the text. I mean, I really learned a lot, which is the most important thing always. And I have had questions just generally, you know, in everything I sort of read about unstructured data. It seems like there's so many assumptions about it, and you know, that overlook like the challenges and the problems of monetization. So when you do the research, you hear a lot of frustration, you know, amongst, I mean, in your case, it would be these various people in finance. So I thought it was really helpful to hear about the problems, right? Also, I work right now, I'm sort of in the context of sub-Saharan Africa, where alternative data signifies something slightly different, related to microcredit and credit scoring. So that was also interesting to like parse this out a bit. So what was very helpful to me was this focus on sort of noise and signal, right? Like beyond the metaphors, which we hear a lot. And I think Andy's initial question relates to that. Like you show the specific practices devoted to making this like disordered or disparate data sources actionable, right, as objects of finance, for example, as like assets. So the question I had, I guess, is like, if we can see how data sources are made into tradable asset classes, right, which is sort of that, like, that's the arc of what you described to us, right? How data sources are made into tradable asset classes, like, how would we best define those? So you don't need to answer this, but like just some comments, like I'm just always struggling with this, right? Because you, as you say, and I agree with you, right? They're not really like data commodities, right? Because they're reusable, or in your words, like repurposed goods. So for example, like there's this production of data derivatives. And as you said, actually in your introductory comments, which was incredibly helpful, like there's this, the goal is the constant generation of revenue. So I would also add, and I'm sorry for my PERN colleagues to repeat myself a million times, but like there isn't really surplus value generated from labor commodification in the Marxist sense. Like the labor theory of value sort of fails here, but I feel like social scientists keep using it. So I think like I guess overall, or one thing you said actually in that regard that was very helpful is what you're describing is like more akin to a subscription model. Watch what Elon Musk does with Twitter. That's all I can say about that. So one of the things we've sort of been debating here is like, is commodity still the term we should be using? We've had a lot of discussions about the category of rent. Sadly, Emma Park is not here, but you know, we've had discussions when Keen has done some presentations from his work. So I personally think that this has implications for the way we subsume the practices that we all describe, not just you, under this general historical term, capitalism. Like, I'm never really sure what the object is. Like, is it the data set? Is it predictive analytics? Is it the data feeds? you know, it's like all of these things. So we do know that, like, generally speaking, what's going on is selling access to data, but there isn't necessarily alienation in the sense of commodity, right, production and commodity markets, right? So of course, sometimes data sets are sold as commodities, but that's like generally not what you describe. So I guess, and this relates to some of the comments that were just made, and then I'll be quiet, but this has sort of reminded me, and especially the conversation we've just had of, and it's going to be very sort of old-fashioned anthropologist in me, Arjuna Potterai's commodity situations, right? When entities, could be anything, are formatted and mobilized as such, i.e. as commodities, right? And that entails the formation of a regime of value. So there isn't any like inherent value in anything. There isn't any like necessary agreed value. It's like a constant, there's a constant production of like these regimes of value. And of course, this is Michel Calon's formatting. I mean, it's, you know, all of this sort of goes akin with some of what Jing was saying. So I guess what I'm asking, so my long-winded thing here is like, are commodity and asset like the only relevant terms? So I don't really have an answer to that. I'm sort of struggling with this, but I guess in related manner, I really have a problem with expressions like surveillance capitalism. It seems to open every article we read. You know, Zuboff is wonderful, but still, or even platform capitalism, data capitalism. Like, it just seems like we're subsuming some really complex transformations under these big categories that entail things like labor theory of value, commodity production and exchange, but isn't necessarily what's happening here. So I know you don't have answers to that very big comment, but just your own thoughts would be wonderful to hear. So thanks.
Thanks, Janet. I'll give it a go. Those are really, really interesting questions and comments, and I think like me and Christian, we also went back and forth about you can even read it in the paper that we mentioned commodities, like there is this in the organizational studies space, the work by Kalinikos and Christina Laimo on where they present data as a commodity and like articulated as a commodity. So we went back and forth about it, and we were also unsure, and that was actually something that we could talk with you about, whether assetization was the right term to describe this process that we're looking at, and that is also actually what you're asking. So I think one of the things that is important to note that is, in order for it not just to be noisy data, then you need to have continuous data, a stream of data in order to train your models. And give it the right input. So one of the things that is problematic about alternative data is that there's not enough of it, and it's like it doesn't have a long history. So there can be some black swans and potential tail events get hidden in that type of data. So I think there is a lot of a high noise to signal ratio in that type of data, which is the big problem, and also why a lot of people are hesitant. But if you look at something like ESG screenings, which is fairly mundane and something that an increasing number of firms need to do because they have customers who wants to be exposed to green investing, green firms or like sustainable companies, then you can obviously get that type of data from different data providers. So that is one area in which like it seems to be clearly an assetization of ESG data by also calling it ESG data, because that can be all sorts of data, textual data on the composition of gender composition in boardrooms or what have you. It can be a lot of different things, working environments, attitudes towards race, what have you. So there are many different indicators and signals, but that are bundled together and delivered as ESG data from data providers. So that is like maybe an example of the assetization where we actually think that seems to be a sort of assetization process going on. A second thing, so like in some cases, it might be, as you say, commodities. So for instance, these image recognition models that are trained on very specific face recognition models that's trained on very specific data sets that are used for all facial recognition models. So there are some data sets that are being used, and they are like maybe they're built out and more faces are added, but it's also like it's that's a commodity maybe, if you will, but so I think in the finance context that would not be super relevant. So but I think the assetization concept fits sort of well with having this continuous stream of data coming in. But the final thing about you saying that assetization might not necessarily be the only or the best concept to use in these discussions, I think that's correct. And I think one of the things that we had also been discussing later on is the concept of infrastructural power, because there are like these like being able to deliver data, having the infrastructure to from the exchanges, for instance, to deliver data to investment management companies, give the exchanges a certain infrastructural power that is interesting in terms of the power dynamics in finance, and there are some shifts in terms of who are the providers of data and how do they do it. But yeah, so that is one of the things we've been talking about.
Yeah. Could I just quickly clarify? I was actually raising more the question of commodity than asset, because if there is a continual generation of revenue, you can see how it's assetized.
Yeah.
But anyway, I don't want to take up time. But yeah, but thank you so much. Yeah, I don't know if Christian too wants to say something or.
I think the observation is really interesting. So I take that that's by using that notion, perhaps we also, subscribe to a lot of other terms implicitly that might not be relevant here. So I totally take that point. I'm completely aligned with Kristian in terms of, it's certainly not the only relevant term. I would agree with him on that. Whether there are better terms than commodities to use in terms of understanding these alternative data, I don't really have a super strong answer on that, but it's a very good point. I think we would need to discuss that carefully, Kristian and I, and
Thank you.
Thank you. Now I have 2 raised hands left and 10 minutes. So please, Jake.
Thanks so much. I'll try and be quick as possible. And just thanks, Pen, for putting this on. And thanks to the authors for a paper that I really enjoyed and learned so much from. I've just got a question that I suppose jumps a bit off what Janet and Keen and Jing have all been sort of touching on. And for me, I interpret a little bit as a question of how quality is passed in this system with respect to alternative data. And I know you answered this a little bit, but I'm just going to ask a more directed question about that, because, in the paper, you give this example in standardization about wheat in Chicago, where you have this standardization happening with respect to the quality of the thing itself, right? And then I'm thinking about, okay, well, how does this work with respect to alternative data? Well, perhaps you can have standardization with in certain respects, like does this data, is it well structured? Does it adequately represent the thing it's supposed to represent, etc.? But that's a bit different from speaking to its quality in terms of like predictive value on the stock market, right? Now, you might say, well, you can't determine its predictive quality. That's crazy. But, the advertising industry is pretty much 100% about that. It's all about we're able to generate metrics about how effective ads are. So one of the big rationales for the sort of computerization of the advertising industry was that it could solve this verification problem that, you know, we never knew whether ads were effective or not. But now when we have a programmatic ad market, we can produce scientific information about the efficacy of the data. And I mean, it's not really scientific. What you have now is all these intermediaries who just make up metrics to sell, right? And so I wonder, with respect to alternative data, whether there is sort of metrics of quality that are being fabricated by the data intermediaries that are then like sold to the decision makers. And, you know, it might be important or not because this data ultimately encounters the like gut instinct of a trader, or as you said, like it sounds like these markets are hugely programmatic themselves, like with 99% of trading happening through automated systems in Australia. So I just wonder if you're seeing the development of the sort of metricization of quality of alternative data, I suppose is the point. Thanks so much.
I can start out here. So yeah, great question. So I'm not familiar with any particular metrics, but of course it also depends on the type of alternative data. There's a huge difference from having text-based, you know, social sentiment analysis of Twitter data, and then looking into satellite imagery. You would need different types of tools, obviously, to deal with these types of different types of data. I don't know whether there are particular metrics that are sort of being consolidated. But what I did want to say in terms of the example that you bring up with advertising, I mean, you're probably right that it's going in the direction that you're describing. But I also recall a recent piece by McKinsey on, I think it was in the London Review of Books, where he's reporting on some of his new research on online ad auctions, right? You know, the auctions where it's determined which ads are popping up on our screens. And he's doing interviews with the firms, you know, developing these types of systems. And I think his point is that there's still a lot of uncertainty in terms of actually getting a good sense of which ads are productive in terms of actually selling stuff. So it might be that they have progressed, if you like, a bit with these new types of systems, but there's still a lot of uncertainty left. But coming back to your question on quality, are you familiar with metrics, Kristian?
No, but no, not specific matrices, but obviously data quality is a very important thing and a very common topic in discussions in finance as well. But I think what one can say is that there is sort of a quality control going on at different stages. So oftentimes these data providers, they can also provide analytics. So they have already synthesized some of the important things in the data, or like labeled the data in a certain way that it is possible to identify the important things that is in the particular data. And then there are firms that wants to just have the raw data and just do all the things themselves and sort out the weed out the noise themselves. But like I don't know, it's a very good question, but I think yeah, I haven't we haven't talked to people about the specific ways of doing that type of quality control, and if there are some standards to do that quality control that are being used.
Thank you. Before I leave the word to Leila, can we go a couple of minutes over if needed?
A couple. Yeah, we don't want, I know some people it's very late at night. So yeah, a couple.
Okay, well, please, Leila, then.
Yeah. Very simple, very straightforward. Yeah, so we were talking about alternative data, but as you've already said, it's it's a very big umbrella term. It covers, and there's sentiment analysis, and then there's like satellite images, right? And then what I'm learning from the discussion is that it seems like sentiment analysis, there's still a lot of like skepticism. There's a lot of obstacle in terms of determine what is even sentiment, and then like how to assess its validity and whatnot. And then as Jean was mentioning, it seems like the investment bank, the investment people are also kind of like withdrawing from us. Okay, that I can get it. But then you, in your paper, you mentioned things like, using satellite images of like retail store parking lots to analyze, like to predict their income, right? Like that seems to me like really convincing and intuitive, right? So I'm just wondering, like, with that kind of alternative data analytics, like, do you see like people starting to like gaining traction, like using it more and more, or actually, as opposed to the sentiment analysis ones where it seems like the skepticism dominate, right? So that's one question. And then another question is like, where do people get these like satellite data? It seems like they need a constant stream of data, like but I can't imagine that people will have private satellites like where they have that kind of access. So it's like, where are these data coming from, and whether or not like there's like a group of like simpler, more convincing, persuasive alternative data analytics that are actually gaining traction. Yeah, thank you.
Yeah, thanks a lot. In terms of using sentiment stuff, I know this is really popular, and some of the big players are also using satellite images. I think I heard a presentation once. It was once again BlackRock, the biggest assets manager in the world. They have a huge department focusing on these kinds of alternative data. And they're basically experimenting with all sorts of alternative data, and they're certainly not the only ones. So that I think these kinds of more intuitive, as you put it, data are being used a lot. I'm not entirely sure where you actually buy this data. Perhaps Christian knows, I don't know, but yeah.
No, it's a good question, but Google would be in perhaps a place to get stuff like that. But no, that's also obviously a limitation in as Jean pointed out earlier about the ecology and the ecosystem. There are some blind spots, and that those blind spots also comes from the fact that informants rarely want to reveal where they get the data, and at least they don't want to reveal what model they're using and what strategy they're pursuing and the type of data that they're using. So sometimes you can get one of them, but seldom all of them, and so like they. We don't have a lot of data on where they acquire this these data sets, but like most of them get it through intermediaries. So the data brokers would be intermediaries that gets them from somewhere else. But for sure, there's a lot of these types of consumer behavior data that are useful to monitor. And also related to supply chain issues. So we talk about observing or monitoring freight routes and shipping and stuff like that, and that has been relevant recently. But also a new big thing related to the inflation is also to be very attentive to the types of job ads being posted, how frequently they're being posted, what types of jobs people are entering into, in order to see where the workforce moving. is unemployment increasing or decreasing and stuff like that. So there are a lot of different also types of data that becomes popular, also related to what is in vogue and also the general economic situation. And so ESG might be slightly less popular in terms of alternative data than it was for 5 years, just 2 years ago. Whereas now maybe things related to predicting a decrease in the inflation or the opposite would be very valuable. So yeah, there are some very straightforward ways to use it that are being used by all quantitative hedge funds and the big asset managers. But surely the social media data that we are focusing on are by some actors considered a bit like too risky, if you will.
All right, now we're 3 minutes past. I really sincerely thank you so much, both for an interesting paper and also very elaborate and illuminating answers to all our questions. So Kristian and Kristian, thank you so much. Is there something you would like to add before we finish tonight?
Just thanks a lot once again for having us. We really enjoyed it. Yeah.
Yeah, I'll
Thank
just
you
second
so
that.
much. Sorry.
Janet, you want to add something?
No, I just wanted to say thank you. Extremely interesting. On that last note, Andy Moon just put in the chat this orbital insight, which is seems to really consolidate a lot of the conversation and a lot of what you've done in your paper. So, but Kristian Hansen, I'm sorry, it's always funny on Zoom. I think I cut you off, but thank you. I just wanted to say thank you.
Right.
Thanks so much.
Unless Kristian, something?
No. I just wanted to say thank you very much for having us.
All right. Good night and thank you, everybody.